What's up, everybody? Matt of Trades here. So what we're going to do in this video is we're going to talk about the perfect trade, or at least one of the best trades I've done using the wheel strategy. So what we're going to do is we're going to go to my chart that I use to track all of my trades, or options trades rather. And as you can see, essentially I started selling so this is my chart. So this is the chart that I use to track and monitor all of my options trades. So we go down, as you can see, I've done a whole bunch. Yellow, these are trades that I'm currently in right now. However, I want to talk about a trade that I did with Rivian. So essentially, run the wheel strategy. Just a quick recap of exactly what that is. This isn't a how to run the wheel video, but just a quick recap. Essentially, you sell puts on a stock, and then when you get called to buy stocks, you start selling calls. The main way to gain profit from the strategy is collecting premium. So we're doing that on Rivian. So first thing I did, obviously, was sell puts. I sold 2 puts. Between those two, we gained $78 in premium, which overall is a 1.11% return on the amount of money that I'm putting up for collateral to be able to do this trade. So kind of a couple things, main things to look at here on this chart. I know there's a lot. The highlighted green ones are all Rivian trades, so these are really the ones we're going to be looking at. The date, strike price is right here. If I'm buying or selling and how many, and what I'm buying or selling, so puts or calls, and the expiration. This is the total amount of premium that I collect selling however many calls or puts that I do, and then this is my return on investment for that particular trade. So first thing we did is we sold 2 puts, collected premium. And on the very first one, we actually got called to buy 200 shares. So that's what happened here. So now what we do is we sell calls. Now it's worth noting that the strike price on the calls that I sell are usually going to be whatever the strike was that I was called to buy at, unless it's super close to that price as it is. So usually you collect more premium when the price is pretty close to the amount that you were called to buy that stock at. So usually you can collect some juicy premiums. As you can see, sold 2 calls, collected $274, which return on investment, the amount in this case, not collateral anymore, but actual money invested into that stock, return on investment is 3.91%, which is phenomenal in 1 week. And then we go down to the next one, same thing. What we actually did here is we rolled our option into the next week. And there's a couple reasons why you might look at doing that, and I'm not going to get into that right now necessarily, but we rolled both of those into the next one. Let's see, that was on the 28th. Expiration was on the 29th. So basically the Thursday, the day before it expired, we rolled it into the next Friday, which in that case we collected another $74, which was a 1.06% return on investment. Same thing here. Looks like we rolled it again, ended up getting $250 in premium this time, which is a 3.57% return on investment. And then we kept going. We're now about almost a month later, not quite. Looks like we rolled our call again, gained $46, which was a 1.31% return on investment. And then we rolled again, got $86 this time. And then it looks like we rolled again, got $64. And then it looks like we rolled again. Now here's what's interesting, something I actually didn't notice quite at that point when I was going over that. So we've been selling calls at the 35 strike. Now at this point, the actual price of Rivian had gone down quite a bit. And right here, we rolled over into the 31. So kind of a bit of a risky thing. Some people might tell you just don't do anything. When the premiums of selling calls aren't really worth a lot, but I was being a little bit more aggressive. So at this point, Rivian was a lot lower, and I felt that rolling it to 31 was going to be beneficial, which we got a 0.76% return on investment. So a little risky. And then again, we rolled it down to the 27. At this point, everything was going down. Stock market is tanking. So we rolled it again to a lower strike and collected another 1.19% return on investment. Now, it's worth noting that whenever you roll, you don't get the full profit. So, for example, right here, I got 0.76% return on investment. When I rolled, I actually didn't actualize that full return on investment. If I had let it expire, then I would have gotten it, but we rolled it a little bit early. And so this is representing how much we would get if we let the option expire. So that's worth noting. So again, we roll it. Looks like Rivian started moving up, so we rolled it back up to the 30. At that point, we gained 84, which was a 1.4% return on investment. And now what happened? So this is kind of why rolling stocks into a lower strike or below your cost basis is getting a little bit risky. So Rivian ended up going back up, and I didn't want to have to sell all my shares at $30, which would have been a pretty, let's see, that would have been $1,000 loss. So didn't want to do that. Basically, would have just lost everything that we've gained so far. So what we ended up doing to make sure that we didn't have our shares called away is we rolled our stock back up to our basically you could call it a break even, and we ended up having to pay, or we lost money doing that, and that's just to keep the position open. So what we did next is I actually sold more puts. I don't remember doing that, but that's fun. So we sold more puts. Oh, okay, at 27.5, and it looks like I just closed that position. So basically, I collected $90 at this point for selling those 3 puts, and then I bought those options back to close the position, paid $14. So gained 90, paid 14, and then again we sold 2 calls at the. It looks like I wasn't very good at putting the strike price, but I'm assuming at the 35 strike price right here because our return wasn't that good, and that's the same for pretty much all of these ones right here. So essentially, 0.14, 0.17, 0.17 percent return on investment, which isn't very good. At this point, we were just working on lowering our cost basis. I made a video all about cost basis and why it's important to keep track of. In fact, this column, I keep track of my cost basis here, which is worth noting right here, for example. We own all these stocks for an average of $35 a share. However, our cost basis goes down as we collect premium. So basically, the amount that I'd have to sell these stocks at to break even overall at this point would be $32.10. So definitely worth tracking. Rolled our call again, got $37. Looks like that one expired, and then we sold calls again, got $38. And then Rivian sold more calls, collected $80, and then we rolled those again. All right, so this is the point where Rivian started going back up and getting a lot closer to our original strike price of 35. So sold 2 calls, gained $250, which is a 3.6% return. And then again, 162, 2.31% return on investment. And again, as we make trades, our cost basis is going down. And then again, we roll our call. This time we get $328 for selling 2 calls, which is 4.69. And what we did this time is we actually sold the 35 and 50-cent strike price because Rivian was probably super close at 35, and I want to see if I could get called out and get a little bit of capital gains, which is exactly what happened right here. So at expiration, the stock ended somewhere above $35.50, and I think in this case by a pretty significant margin. However, with that being said, so we sold all of our shares at $35.50 when we originally bought them at $35. So 50 cents profit for each share, which basically is $100 with 200 shares. So we ended up getting $100 of capital gains in this trade, which I track right here. And then this number, when I close out a wheel cycle trade, I'll put the full return on investment here. So basically how I calculate that is I take the amount of money that I collected in premium while running this wheel cycle, which in this case was $1,577, and then find out what percentage of that, what that is versus my initial investment, which in this case was $7,000. $7,000 because we bought 200 shares at $35, $3,500 for each option, $7,000. So overall, in the almost 4 months that we ran this strategy, we had a 22.53% return on investment. If I had been doing this with my entire portfolio, that'd be freaking awesome. If I could do this with my entire portfolio every 4 months, again, I'd probably be a millionaire pretty quick. But that's not how real life works. So, yeah, just I hope this video was helpful and insightful at all. Things to consider when you're running the wheel, when you should roll. If you want to be a little risky and roll to a lower strike than what you actually got called to buy it at. All things to consider. So I like this trade because I had a little bit of everything. It got to the point where it was looking pretty bad, and the price of the stock was a lot lower than what we owned it for, and so did a couple risky things, and we bought calls lower than our original strike, at a strike that was lower than our original strike. Well, again, I hope this is a video. If you want to see more videos like this, please like and subscribe. I'll see you next time.